and get started, Stefan? You want to start off?
Sounds good. Yeah. So let me start up. So everyone, this is Finance Meets Real Estate. We have Badri Malynur here today. So he's the co-founder of Avestor, Avestoring. So it is a real estate technology platform that helps you build your real estate portfolio in a more efficient way. He'll tell me more about it soon. So with that, I'm passing it on to Badri. I really look forward.
Okay. All right. Hey, thanks a lot. I really appreciate this opportunity, Stefan. So basically what we are going to do is the initial portion of the talk is more of an educational talk. It's how to build a diversified portfolio in real estate. I don't mean investing one deal or two deals. So to be frank, you'll know a little bit of everything in the talk, but hopefully you won't know everything about everything. I mean, I'm sure many of you would have done some elements of this, and we'll go from there. Some standard legal stuff. Avestor itself is open only to accredited investors. This is not a recommendation or a solicitation of any securities transaction. Real estate investments can be fairly illiquid. It's not appropriate for everyone necessarily. Avestor is not a broker-dealer or a registered investment advisor. And this is not constitute to be legal, accounting, or tax advice. So please, our investment advice, please consult your broker for that. Yeah, So, you know, everybody, well, a lot of people are familiar with building a stock portfolio. And even a bond portfolio is not that hard to do. But building a real estate portfolio, again, I'm not talking about one product instrument here or one property there. How do you build a portfolio? I mean, it's not that easy to do. And I'm not talking about the Bill Gates of the world who can throw hundreds of millions of dollars and get properties all over, right? I'm talking about the average Joe, the rest of us. So building a real estate portfolio is really hard. You know, you want to move from stocks and bonds and cash to have a slice of real estate. Since you are in a real estate meetup group, I'm not going to tell you why real estate is good. Let's go past that. Let's say some amount of real estate is good. We'll just take that as a given. Finding opportunities, the deal structures are very complex. There are significant capital requirements. If you want to build a total portfolio, you have to manage the risk. And you have really not made any money until you have made money, right? I mean, until you exit and you know what's the right time to exit and all that. So there are lots of issues to deal with. So what we will do today is we'll talk about the different types of real estate deals. The top considerations, there are 6 criteria you should look at when you look at building a portfolio. We'll talk about each one of those areas. We'll give an introduction to crowdfunding. Many of you are familiar with it, not all of you are familiar with it. And we'll then finally give a short demo of Avestor and tell you how Avestor allows you to build a real estate portfolio. I'm not saying that's the only way to do it, but that's one easy way to do it. So what are the different ways you can invest in real estate? You obviously can purchase individual properties. I mean, that's the most obvious one. When I say individual, I mean, okay, 4-plex, 3-plex, whatever you want to purchase, right, on your own. You can buy shares in private REITs or funds. You can invest in syndication deals. We'll talk more about that. Some of you may already be familiar with it. Just give me a rough sense, if you could type in the chat box, how many of you have invested in syndication deals and are familiar with it? Invested, answer one question, and familiar with it, question number 2. If you could just type in, I'll roughly get a sense for it, please, as I continue talking. And then some of you have done hard money lending, and you can also invest in real estate loans, and we'll talk a little bit about that too. So the direct property purchase is the most obvious one. I'm not talking about your primary house. That's kind of outside I mean, we're talking about investing. I mean, your house is for living, right? I mean, I'm not saying it's not an investment, but you can purchase a second home or a small multifamily, standard thing, 25% cash down, 75% loan. You have to manage the property or get a property manager. The main advantage is you have complete control over your investment. You can decide when to exit if you want to exit. And you have a renter paying off your mortgage. All this is obvious stuff, right? And then you get the tax benefits of depreciation, where you can depreciate the real estate assets over 25 years. The disadvantage, which is you're taking on a debt burden. B, here is the key point. The first property is okay, second property is okay, but do you really want to buy all your properties just down the road? I mean, now you're taking a single market risk. By no means I'm saying don't invest locally, but don't invest all of it locally is the only point I'm trying to make. And there is no liquidity on the invested capital, yeah? So another choice, all this I'm going to go relatively fast. And if you want to stop, type in your question in the chat box. I may answer the question right away, or sometimes I'll defer to the end, depending on the type of question, yeah? But if you have any questions, feel free to type in the chat box, please. So there are real estate investment trusts which trade in the New York, in the stock exchange, New York, NASDAQ, or whatever. And the main advantage is the high liquidity, very easy to research, low capital requirements. But here is the biggest disadvantage I have for public REITs. They trade like the stock market. If the whole point is to diversify away from the stock market, the average REIT was down 70, 80% in the March crisis. And even now, even though the markets are at all-time highs, they're still down 30% or so, right? And there is very little transparency on the actual investments. You get a kind of a one size fits all. I mean, you invest in something, you kind of get the whole size of the pie. You don't get to pick what you want to go in the pie, right? So you can do private REITs. This gives you a little more customizability, and there's a little more transparency on the investments, and they're available directly through brokers or directly, and potentially higher returns. But the biggest advantage is if you choose the right private REIT, you get some of the tax benefits through the LP tax structure. You get some of the depreciation benefits like owning real estate directly, yeah? And then there are real estate loans. I know some of you have done that before. I don't mean the 30-year loan. I mean, my God, what incredible, you can get a 30-year loan for sub 3%. I can't believe I'm saying that. But I'm talking more about fix and flip loans, where these are short-term loans, which can be for single or multifamily. Typically, the loans have the first lien against the property, and investors receive fixed interest. You don't get any upside. I mean, this is a loan, right? Even if the property values go up, you don't get any upside. The main advantage is short-term investments, very liquid. You can get returns from 6 to 12 to even 13% potentially. And as long as you take the first lien and the borrower has put 15% down or 20% down, there is enough downside protection. The con is you don't know the track record of the borrower. Any income you get from these loans is considered interest income and subject to regular income tax. And here is the main point. If you're not careful about what type of loans you invest in, foreclosure processes can take up to 24 months. So when you do loans, it's important you invest in states which have non-judicial processes where you don't have to court to get somebody out on foreclosure, yeah? I'll talk a little bit about how you can invest in loans. Right now, I'm just giving you all the choices. We'll talk about how you can invest in each of these categories. So the syndication deals, I think so far I've not met nobody in the chat window has said they've actually invested, but many are said they're familiar with it. But let's do a quick recap, if I may. These are large commercial real estate deals which allow individual investors with as little as $25,000 or $50,000 to invest in a deal. So which I'm sure all of us cannot go buy an apartment complex on our own. You can either have a new construction or value add. In a new construction, well, it's pretty obvious, right? It's a new construction, you build it. Typically, the person builds it and stabilizes the rent and then tries to resell it for a higher rate after 4 or 5 years, or sometimes 3 years. In a value add, you purchase the property, you improve it, add some improvements, maybe add a basketball court or improve the quality of the apartments and try to increase the rent. And then you use a higher cap rate and try to, we'll talk about some of this terminology, and try to sell it a few years down the road, yeah? So this deal is generally structured as a limited partnership. The way it works is, let's say you have a $1 million apartment. Obviously, you won't get an apartment for $1 million. I'm just using a round number. You may take $700,000 as loans. $100,000 are put up by the GPs with the general partners, which may be 2 or 3 or 4 of them. And then there are various limited partners. The remaining $200,000 is put by them. and then the sponsor and investor share in the income and profits, right? I mean, so this is something all of you are familiar with. I'm just recapping again. Here are some basic terms you need to be aware of when you look at syndication deals. Internal rate of return. You guys are all finance professionals, many of you, so I'm not going to spend too much time. It's just the compounded return, takes into account the time value of money. Remember, there's only an estimate, not a guarantee. Cash on cash return is, let's say you are borrowing 800,000 and you're putting 200,000 off for 200,000. After subtracting all your expenses, what type of return are you getting on the cash? The equity multiple is the simplest thing to understand. If you invest $1,000 and you get $2,000 after 5 years, your equity multiple is 2. You're basically doubling your money. This gives a very different perspective than the internal rate of return, and is a good way to augment the internal rate of return, which takes into the account the time value of money. This doesn't take into account the time value of money, yeah? And preferred return is something which syndicators give to investors. Basically, the basic idea here is that the first 7 or 8% of any of the profits go to the investors, and then the rest is split between the investors and the general partners. And then there is something called the debt service coverage ratio, which is basically how much, when you divide the income by the net operating income by the debt, and how much of the net operating income is going to debt. You clearly want something which is more than 1. I mean, if you don't even have enough money to cover debt, well, you're taking a risk, right? So again, to recap, this is how it works. The lenders provide the primary loan 65 to 70%, investors put 25 to 30%, sponsors put a relatively small amount. These are also called the general partners, 3 to 5%. Remember, the lenders always have the first lien against the property. If anything goes wrong, they get the first money, yeah? And there are different profit sharing structures. Investors and sponsors share equity. Typically, there's one tier, but sometimes there is 2, and sometimes there's even 3 tiers. What I mean by that is the preferred returns. We talked about that earlier. The first 8% or 7% goes to the sponsors. And then there are multiple splits. For example, you can get 70% can go to the investors and 30% can go to the sponsors, which is a fairly typical split. But keep in mind that the sponsors take other assets like asset management fee and property management fee, yeah? And we have a lot more information about how syndication deals work. If you go to avestor.com and you go to our blogs, we have various blog articles on how syndication deals work, yeah? So what are the main advantages and disadvantages of syndication deals? The main advantage is you get to stake in a commercial property, which you cannot easily do, right? And higher potential returns, you get all the tax benefits, you get passive income and the tax benefits of basically owning real estate. You get all the depreciation benefits. The main disadvantage is $25 to $50 to $100,000 per deal. So you really need almost $500,000 to build a diversified portfolio. I don't mean to get into one deal, but you want a collection of deals. You don't want one deal and that deal goes wrong and all your money goes away, right? And then there is no liquidity. And here's another disadvantage. There are so many syndicators out there. How do you measure what is right? I mean, you have to go through it and it's not very obvious, yeah? And there are so many crowdfunding platforms. You have to be prepared to tie up your money for 3 to 7 years. And the GP has full decision-making authority. Investors do not have much authority over it. And remember, the first lien is always with the lender, yeah? So here are the top misconceptions. Passive income is not guaranteed. I guess passive income is guaranteed is the misconception. At the end of the day, if there is a large vacancy, you won't get even your preferred return. It's all preferred return just means it's not guaranteed return. It just means that the first 7% goes to you. It doesn't mean it's guaranteed. And remember, the target returns are not annual. When you say you get internal rate of returns, a lot of the money comes in year 3, 4, and 5. It doesn't come in year 1 and 2. Yeah. And the deals don't always exit on time. And here is a very important point. There are some master marketing syndicators out there, but fancy presentations does not equal to great deals. I mean, you have to look at the PPM, you have to analyze it, and syndication deals are by no means low risk until you do your due diligence. We have a lot more information about this in our blog, again, in avestor.com. So the link is over there. Yeah. So I'm going to switch. Feel free to ask any questions, please. You can type in the chat window. I'm going to talk about what are the top portfolio considerations to build a real estate portfolio. Again, I'm not talking about an individual deal. I'm talking about building a complete diversified portfolio. Yeah. First thing is the portfolio structure. What are the different pieces you're going to put in the portfolio? Stefan, for example, said that he invests in individual properties. Great. But maybe he needs to mix it up a little bit. Maybe he needs to add a few other things. And you want to diversify across multiple asset classes. I don't mean Bitcoin and cryptocurrencies and things like that. I mean, within real estate, you can diversify across multiple subclasses. You have to know what criteria to use to select a deal. Make sure you look at your cash flow strategy. Make sure you have multiple liquidity points. You may think you may not need the money, but you really want, you never know. 3 years down the road, you may suddenly need some money from that. And then you want to maximize the tax benefits. So we'll talk about each of these points in more detail. The first thing is, think of your net worth. How much do you want to put in real estate? I can't tell you the answer. It can be anywhere from 10 to 50%, or even more sometimes, potentially depending on what you're looking for. Let's say you have a $1 million portfolio, and let's say you're targeting 15 to 20% in real estate. Now, this is kindergarten math. You don't need to be a finance professional for this. You could invest in 2 single-family houses at 100K each, taking some debt. You could do 4 private funds, or you could do 8 syndication deals, or you could do 40 loans at 5K each, right? There's a different ways how you can use some combination. But the key point is, I want you to think of this like a jigsaw puzzle. By all means, take whatever piece you want, but you have to think about how all the pieces fit together, and where do you want to be 5 years from now, 10 years from now, 20 years from now? That's the key thing. By all means, take the first property, invest in the first syndication deal, invest in the first REIT, but think of what your subsequent pieces are. I'm not saying, you make a plan. Sometimes plans don't go according to plan, but that's okay. But at least you should have a plan in place. Yeah. You want to diversify across multiple markets, across multiple geographies. You may say, oh boy, I need a lot of money to do that. There are ways to do it without having too much money, because each market zigs and zags. They don't go up and down at the same time. In terms of pricing and the demand and everything else. You want to diversify across multiple asset classes. Maybe in a future talk, I can actually go into each sub-asset class, but in this class, we'll just talk about multifamily and student housing a little bit. In each of these asset classes, you could do new construction or value add. At Avestor, we invest in all these asset classes, and we are also planning to add senior living, mobile home parks, industrial warehouse this year. So in one platform, you can invest in multiple asset classes. We'll talk about how we do that in Avestor. So multifamily asset class, the most popular asset class. Everybody needs a place to live, I think. And fairly safe, relatively speaking. Lots of investing opportunities. There's good cash flow. You can invest in class A, B, or C, depending on what type of properties. Class A are the more of the luxury, higher, bigger city kind of things, where the cash flow is less, but hopefully you'll get more in appreciation. And the main disadvantage is you have to be very careful about the real estate sponsors, vet their experience carefully. And sponsors often overestimate the rent which they'll get after a rehab, and be prepared to be invested for 5 to 7 years. Yeah. So student housing class, again, I'm not going to talk about all these sub-asset classes. We don't have enough time, but maybe we'll do a new webinar, a later webinar, where we'll go into more details in each asset class. Really good cash flow and well-managed properties. Generally, the renter demands are less. Students are not as demanding as just if you're not staying in the house. As multifamily. Students are more budget conscious, so ensure that the projects are not very high on rent. And there is a little higher risk renting to students, right? But it's relatively stable income, because once COVID goes by, people have to go back to school. They're not, people are tired of Zoom. They want to go back to school, and student housing is a relatively safe asset class. And another asset class which does relatively well, where Avestor does a lot of investments, is the self-storage. Have any of you invested in self-storage before? Maybe you can type if anybody has invested in self-storage. Pretty good asset class in times of recession. Yeah. So So in terms of selecting a particular deal, for single property purchase, obviously you have to look at the specifics of the property. What is the crime rate? Is the city growing? How is the subdivision? The price of the property and all that, of course. The debt servicing risk. Are you getting enough money to pay back the debt with some buffer? Are you leaving aside some money for unexpected repairs? Obviously, you take a look at the renter. I mean, is it a single renter, multiple renters? The advantage of multifamily is all your rents are not going to go to zero at the same time, unlike a single family house. If the single family house person leaves, 100% vacancy, right? I mean, that's not good. Then for real estate loans, in addition to all of this, you have to look at the risk of the borrower and the foreclosure flexibility. I talked about that, right? I mean, where you want to make sure that you invest in states which are not highly tenant friendly and more investor friendly, and where you actually don't have to go to court for getting people out of foreclosure. Yeah. And then for syndication deals, you obviously have to look at the capital stack, look at the detailed structure of the deal. Is it investor friendly or sponsor friendly? The track record of the sponsor. How many deals has he done? How many deals have exited? What is the internal rate of return on those deals? I mean, we look at all these parameters in Avestor. We look at about 40 different variables. So then you obviously need to look at the cash flow. Purchase a rental property, obviously you get the monthly income and you have loan payments going on, and hopefully you get some principal return and appreciation at the end. In terms of a debt deal, you may get monthly interest, or sometimes some debt deals, you get the interest as accrued interest only at the end of the loan. And in terms of equity deals, for value add deals, you get the distributions right from day one. Whereas for new construction, you may not get much distributions for year 1 and 2, and a lot of it may be principal appreciation, right? So build your portfolio based on your cash flow requirements. I mean, there are some things which you'll get cash flow, maybe use a mix of new construction and value add, and maybe you invest in some deals which give you interest at the end and some deals which give you monthly interest. These are all factors you have to consider, yeah? So. In terms of liquidity, again, structure your portfolio so that you have multiple liquidity events, and don't wait for until one liquidity event when you try to sell your property. And tax implications, real estate loans, any interest you get is 1099 income. Be careful with that. Syndication deals, you get a separate K1. The advantage of that is you get the depreciation benefits, and so you get long-term capital gains on that. One of the biggest advantages of Avestor, I'll talk about that, is even if you invest in 25 syndication deals, you get a single K1. Whereas if you invest in syndication deals on your own, each deal is a separate K1. And then for private REITs and funds, you typically get a 1099 div or a K1, and you'll have to, TurboTax and things like that handles K1s relatively well. Yeah. So moving on, again, I don't see many questions, but if you have any questions, I'll take a pause. Feel free to jump in and I'll answer them now or towards the end. Any questions so far? Okay, so let's move on to the crowdfunding topic. This is what my friend calls the uncanny grasp of the obvious. What is crowdfunding? Well, it's very simple to explain. It's crowd and it's funding. It's basically where you get your money from a crowd, from multiple sources. And there are various online marketplaces that gives investors to invest in real estate deals, like CrowdStreet. We'll talk about some different crowdfunding platforms. You can participate in larger projects just like you do in syndication deals. Again, these are passive investments. You're leaving the complexity of the management to somebody else. And this goes back to our key message. What's our key message? Build a portfolio, build a diversified portfolio. Diversify across multiple asset classes, diversify across multiple markets. It's a lot easier to do that with crowdfunding, yeah? And there are a few things you should be aware of. Crowdfunding platforms are more like a seller's agent. What do I mean by that? They are more interested in raising money for the investors. They're not necessarily looking out for you. I'm not saying that cheating you or anything, but their interests are not aligned with you, okay? So basically, you have to ensure that you read through all the PPMs and the documentation and ensure that, don't fall for the pretty pictures. And don't go based on the advertised returns. A 25% deal is not necessarily better than an 18% deal. You have to look at the pro forma and see, can they really generate the 25% return? Are the rents reasonable? Are they assuming very high appreciation metrics? Or is that consistent with past history? And it's very common for the deals to take longer than anticipated. We talked about that, right? So there are different crowdfunding options. Not all of you may be familiar with all of them, but I'll go through a few. Again, you don't want to buy all your properties in the street down the corner. If you want to target homes in other markets for rental purchase, Home Union and Roofstock are good portals where you get turnkey homes which are rented and they can even take care of the renting for you. These are not necessarily recommendations. I'm just giving examples. For private REITs and funds, you can invest in things like you can diversify into multiple commercial properties. Fundrise and Realty Mogul are some examples. I would certainly put Avestor in that category. And Fundrise, for example, you can invest without being an accredited investor. And then for syndication deals, CrowdStreet and Equity Multiple are places where you can invest in multiple individual commercial equity deals. And then for debt deals, Fund That Flip, Patch of Land are examples. I kind of like ground floor too. You can invest as little as $10 per deal, believe it or not. So where you're actually loaning $10 for fix and flip loans, and you get interest between 7 to 11%. Yeah. So with that is kind of the overall just introduction to how do you build a diversified portfolio. I'm going to now transition to what Avestor is about and how Avestor is one platform for building a diversified portfolio. I'm literally going to pause for a second and see if you have any questions so far. Makes sense? Is this all information you already knew? Okay, I guess maybe questions will come at the end. I'll continue chugging along. So what Avestor is, it is basically, think of it like a salad bar for real estate. What does that mean? When you go to a salad bar, you can say, I want some lettuce. Me being of Indian origin, I eat a lot of spicy food, jalapenos, whatever it is. You get to pick and choose, and you get to pick and choose how much you want. And then you build a diversified portfolio which spans multiple asset classes and multiple timeframes. You can even specify your liquidity needs, and you get a combination of passive income and capital appreciation. So you can say, I want to invest $5,000 in this, $10,000 in this. I already am living in New York. I don't want any exposure to New York. I'm done. Nothing wrong with New York. I'm just saying you already have exposure to New York. You may want exposure to the red states or Texas or Georgia. You can specify any of those criteria and pick and choose a custom portfolio. It's not one size fits all. So what we do is we evaluate and pre-invest in the best deals. Key point. We are not just making recommendations. We put our own money and we pre-invest in the best deals. The investors customize the portfolio to align with their investment goals. You can invest in different states and time horizons and sub-asset classes. I already talked about that. And the whole thing is very, very transparent. Think of us like, okay, salad bar is one analogy. The other analogy I'll give you is the Robin Hood for real estate. So you log in, you'll see exactly how much you have invested in each deal, how much money it's made, when it's supposed to exit, and I'll give you a quick demo of the platform too. And then as the deals exit, you can decide to reinvest the money or you can withdraw the money. And then all of this is packaged in one single LP structure. So even if you invest in 25 deals, you get a single K1, which dramatically gives certain tax benefits. And it also significantly reduces the complexity of your taxes. And you get a diversified portfolio in one shot for as little as $25,000. You can invest $25,000 in as many as 25 deals. Yeah. So again, to recap, we research the deals, we pre-invest in the deals. Our message is very simple: diversified portfolio, just 2 words. Just if you don't remember anything else from this talk, just remember diversified portfolio. And hopefully Avestor, but even if you don't remember Avestor, that's okay. So then we invest in these deals, we cut these deals into slices. You come along and set your overall portfolio direction. It's just like you go to an investment advisor and say, I want 60% stocks, I want 40% bonds, whatever. It's a similar concept, right? We match these slices and allocate it to the investors. And we do both debt and syndication loans. We do real estate loans and syndication loans in the same platform. As far as we know, we are the only platform in the country which does that. And then you get a pro rata share of the earnings. You can withdraw the money as the deals exit, or you can reinvest. That's the basic idea, okay? So here is a hypothetical investor portfolio example. Don't spend too much time on this because I'm actually going to show you an actual example. Why bother with hypothetical examples when you can do an actual example? But the main point is you're diversified across multiple markets. You can invest for different time horizons. You can specify that. You're invested across multiple asset classes, single and multi-family houses, student housing, apartment complexes, office and mixed-use space, retail centers. And you can put as little as $500 in debt deals and as little as $2,500 in syndication deals, where you get actual ownership, yeah? So as I indicated, we do both syndication deals and real estate loans. Syndication deals, typically the returns are between 13 to 25%. And the real estate loans, short-term loans, 6 to 15% months. And typically the interest rate is between 7 to 13%. We never invest in any loans where we do not have the first lien against the property. And we also never invest in any loans where the borrower has not put at least 15 or 20% down. So if something goes wrong, boom, you can foreclose if you want. Typically, we don't foreclose. You negotiate, you try to get your money back. And so there is a huge advantage in having the first lien against the property. Yeah. So here are some of the deals we have invested in the past. Student housing, Morehouse School of Medicine in Atlanta, 18% IRR, an apartment complex in Michigan. There's a self-storage in North Carolina, retail center in Oak Brook Station. This is rented to Lowe's, essential businesses. These are not like nail salons and things like that. A multifamily in Phoenix, you generally get the idea. Some are student housing. We really like this last deal. It's a single family rental community. The whole community is built for renting. We invested in phase 1 and phase 2, and both got sold out really fast. Yeah. So these are just some sample deals which we have done in the past. So with that, I'm going to walk into a demo, but again, feel free to ask any questions you have so far. If I don't see any questions.
Actually, I have a question, Badri. So
Okay.
what is the range of the returns you mentioned on the debt deals, on the real estate loans?
The real estate loans is between 7 to 13%.
Okay, thanks.
I would say 7 to 12%. Rarely we get a 13%. So, and the other question in the chat box is the target IRR, that is annualized. When I say 15 to 25, it's annualized, but you don't get it annually. Do you understand what I mean? If you, some of the money comes in year 4 and 5, and then you annualize it. These are target returns. In real estate loans, it's kind of semi-guaranteed by the property because you have a lien. The IRRs for syndication deals is just an estimate. There's no guarantee. Yeah. Because when you do syndication deals, you're actually becoming an owner. I mean, there is no guarantee in real estate in ownership, right? I mean, you're taking it, you need the rentals. So those are just estimates. Hopefully I answered your question. So it is, the IRR is annualized over the life of the deal. But so if it's compounded, taking in the time value of money, but you don't necessarily get 15% every single year, year in, year out. It's what the estimated return is by the end of the thing. Sometimes a lot of the money comes in year 3, 4, and 5. So when you log in, think of it like Robinhood for real estate, right? I told you. You see the account balance. These are the number of deals this person is invested in. For as little as 56,000 is invested in 51 deals. This is the return on the deals which have exited. You can say, that sounds a little low, but remember, syndication deals take longer to exit. These are all debt deals which have exited. Syndication deals typically take 3 to 5 years and sometimes longer. We typically invest only in 3 to 5 year deals. There are some deals which take 7 to 10 years. We don't invest in that. These are the total earnings. And then this is the breakdown between the debt and equity. For a lack of better word, I'm going to just call this a vanity map. It's something you show off to your friends, I guess. I don't know. It shows you how your investments are distributed across the country. You can click on anything and get more information. These are the deals which have exited. Again, this is the breakdown between the different categories. And this is the liquidity graph which I was talking about. Notice that when I say liquidity, this is not a precise number. This is not like a CD. You're not going to get your money back June 30th, 2022. It's approximately during that year. We talk to you when you join and you say, I have a kid going to college in a couple of years, or I'm buying a house in 3 years. I need some of my money back. And we structure you in such deals so that you get your money back approximately in that time frame. Yeah, not a guarantee, but we try our best. Yeah, so. And then you can go to your details page. And what this gives you is what you would expect it to do. Sorry, it's a little slow today. You will be able to see each individual investment. And for example, in the commercial debt, this person has given $1,000 loan for this Manhattan apartment complex. He's made $100 so far. When you click on it, you get a lot more information. You'll get access to all the documents we have from the syndicator or the loan, and then an approximate exit date. And for example, if you go to the equity deals, these are all the syndication deals. Let's click on this, for example. This is a self-storage deal. I think I showed you that in Raleigh, North Carolina. He's made he's invested $2,500, made $193 so far. You click on it, and then you get all the information. There are some additional photos, the original offering document, and our summary of the deal, any updates on how the project is going. So you go there and you have complete access to your information. Any questions about the demo so far? And you can decide what you want. We can completely take care of the investment for you. Initially, you can come in and say, I want 20% debt, 80% equity, and then we auto invest for you, or you can pick and choose your investment. It's completely up to you. When you go here, you can actually see what investments are available. And then you can pick and choose again, depending on how many people. Azure sometimes gets a little slow. This is on the Microsoft Azure platform. And say, for example, here, these are all the commercial debt loans. You can kind of see these are the deals which are currently available in the platform for investment. You can see what the rate of return is. Let's go to equity, for example. And so these are all the deals which, if you join the platform tomorrow, these are the deals which are available and you can pick and choose, right? These are some apartments in South Carolina, 16% IRR. This is actually a collection of 4 multifamily apartments. Even though you invest in one deal, you're actually investing in 4 separate deals. And 20% IRR, Kingston, New York. I don't know if that's close to you guys. And Coconut Creek, Florida, another 20% IRR. Lakewood Apartments, Texas. You can see it's highly diversified in terms of states and cities. And we love this deal. This scored very high. It's all, normally we don't invest a lot in office complexes, but these are all long-term medical office leases. And the operating income is very, very high compared to the investment in the deal, yeah? So I will stop the demo for a second and go back to my presentation, and then we'll have plenty of time for questions. So one question is, what is the minimum amount of money invested to start using the platform? 2 important points. The platform is open only for accredited investors. If you don't know what the definition of accredited investor, we have a blog which talks about it. The minimum investment is $25,000, but you can split that in as many as 25 investments. So 25,000 is something we recommend 50,000, but you can start with as little as 25,000. And that's what you would put in one syndication deal. Here you can invest in 10 different deals. And I do need to tell you about the platform fees. We are not a nonprofit organization, unfortunately. And it's 1% fees For accounts above $100,000, most people have said the value we provide is more than worth the 1% fee, and 1.25% for accounts below $100,000. Okay, and it's calculated daily. So on an average AUM, it's not like some monthly or anything like that. And then there are some little bit of additional expenses. It'll be between 0.25 to 0.5%, but my suspicion is it'll be a lot closer to 0.25%. Because as the platform grows, and these are actual expenses tied to accounting and filing the tax return and things like that. So you should be looking at paying about 1.5% per year, generally, if you join the platform for accounts below $100,000. Okay. Today, overseas investors cannot use this platform. You have to be a US resident or a US citizen, but we are working on some other variations of these funds where overseas investors can. A couple more slides and then I'll pause. We have a very, very sophisticated model in terms of how we evaluate these deals. We do a detailed analysis of the capital stack. We look at the financial risk, stress test it. What happens if 20% vacancy is there, 25% vacancy? What happens if there are unexpected repairs? We look at the deal structure. Is it investor friendly or sponsor friendly? I mean, if the sponsor makes all the money, well, why do we want to invest? Take a look at the track record of the sponsor, and then we do obviously individual assessment of the deal. And we pre-invest in a very small subset of the deals. The funnel is very large. We work with dozens of syndicators and multiple crowdfunding platforms. And then we pre-invest our own money in a very small subset of deals. So I shall pause here. And what I will do is let me type in my contact information. I'm just going to cut and paste it. You can type it in here. I'm also going to type in my contact information. And I'll actually get your emails and I'll send you a short email. Don't worry, if you're not interested after that email, you won't hear from us. But if you're semi-interested now or down the road, we would love to at least have you on our email list. I put my full contact information in the chat window. You can cut and paste it. That is my personal mobile number. You can reach out to me. And so that is the kind of the summary, actually. So I want to give plenty of time for questions. I think we are right on time. And one question is, I used to live in the US, but no citizen or green card holder, and then moved to other countries. Just talk to me offline. Right now, I believe it's open only to US residents. I can talk to our, just send me an email and then we can talk. But right now, if you don't have a US address, I don't believe you can, but yeah, so. Feel free to unmute yourself or feel free to type in the message box. Hopefully you found the platform interesting. Hopefully you found the talk useful. I'm certain some of it is old information for you, but hopefully something was new.
Yeah.
Can you explain accredited investor?
Sure. Let me do that. I think I have a slide on that. Okay. Can you see this? We have another definition too, but let me start with this definition. The simplest definition is, hopefully you can see this, I have both the things. So income of $200,000 for the last 2 years is singly, or $300,000 if it's joint, or $1 million net worth excluding primary home, okay? But here is the good news. Here is the good news. SEC has become a little more liberal now. And by the way, we have a lot of information on our website. I mean, avestorinc.com. I encourage you to go look at that. We have frequently asked questions, custom portfolios, example portfolios. We accept self-directed IRAs, solo 401k plans. But going back to your question, there is a definition of the old definition of an accredited investor. Now, SEC, you can please look at the blog here. SEC opens the door for more access to private. They've expanded the definition of accredited investor. So if you don't qualify for the income and the net worth requirement, you can take a Series 65 exam. And if you contact me offline, I can help you. It's a nice exam to take. This expands the investment opportunities you have, and you become accredited even if you don't qualify by income or the net worth requirement. So Did I answer your question?
Yes.
Thank you. I think, Stefan, you had a question?
Yeah. Thanks, Badri. Actually, I wanted to ask, in terms of like your partnership or like finding deals on your side, like all the different deals that you offer that you pre-invest in. So what is your, so you mentioned some obviously relationship with syndicators, relationships with crowdfunding platforms. So let's say if you have deals that are single family homes, are those done through crowdfunding platforms, or do you also connect with individual investors, or you only connect with syndicators crowdfunding essentially?
So I should clarify the single family houses. Today, you cannot buy a slice of the single family house. We are thinking about it, but today you cannot. The single family investing is for fix and flip loans. It's not for investing in the house itself.
Yeah.
But we are thinking of creating a fund where you can invest. The minimum investment will probably be higher, but you can get 20% of a single family house or something like that. But that's something we are thinking about. It's not ready yet. So, and to answer your first part of the question, we work directly with syndicators, and we also work with crowdfunding platforms, and we have a variety of sources for our multifamily deals. For single family houses right now, it's only for the debt portion, not the equity portion. So.
Good. And in terms of timing, so let's say just as an example, like for our viewers here. So if we take as an example, let's say there is a multifamily syndication deal. And you guys, what would be the process from your perspective? So you would pre-invest in that deal, and you would have, you know, because there's a certain timeline, right? They would raise capital within this timeline.
No, we don't have to raise capital. So what we pre-invest our own money. So the investors can come along at any time. For example, I showed you some of our available inventory, and we have built the legal and the technology infrastructure to cut our pieces into small slices and then transfer it. And typically when a syndicator approaches, if there are any syndicators in the call, I don't know if there are, by all means, send me an email. We are happy to evaluate your deal. And if it passes, we'll, as far as you're concerned, we are just a single investor and we'll pre-buy. So then as far as you as a passive investor come along, when you put in $25,000 or $50,000, maybe you don't invest all of it immediately. You invest most of it, and then when the next deal comes along, you can get to pick and choose saying, I want this deal or I don't want this deal. Or if you want to put it in auto investing mode, we can do that as well. Did that answer your question, Stefan?
It does partially, but just to confirm, like from the perspective, like once you have pre-invested in a deal, so to say, if you're an investor in that deal in whichever form, a limited partner, I assume, right? From that point on, like once you have like, once you slice it onto other investors, like how does that work timing wise, and like how does it all align, like from which point doing in the return?
So when we pre-invest in a deal, the deal usually takes 3 to 4 weeks to close or whatever, right? I mean, and then we get that deal on the platform, and then we, let's say we invest $100,000 in a deal, and we cut that into 40 different $2,500 slices. And as soon as you put your money in, we automatically transfer the slice to you, and your returns are calculated from the day you invested in the deal. Still not sure if I answered your question or not.
Okay.
So as soon as you put your money, the deal is automatically transferred on day one to you. Day one for your day one, not our day one. Yeah.
Sounds good. And do you have a minimum deal size for the syndication deal? So let's say if we have syndicators that here that who may be interested in you know, having
typically we do $50,000 to $100,000 per deal.
That would be your investment, but in terms of the deal size that you would invest in, does it have to be a project, let's say 5?
No, it's no, there is no deal size. It just depends on the financials of the project and that entire collection of. We are not. We are agnostic to geographies. We are agnostic to asset classes. So far, frankly, we have stayed away from mobile home parks due to ethical reasons. But there are operators who run that ethically. So, but otherwise, we invest in all asset classes, all states, all deal sizes.
So in the event you guys have like a really big project to invest in, you would still limit your capital, let's say, to like 50, 100K. So you try to.
I think so. I think so. As we grow bigger, we may increase it to 150 or 200,000, but not beyond that. simply because we would rather invest in $10,000, $100,000 deals than put $1 million in deal. Because we want to, really it's about the message which we conveyed in the beginning, right? The diversified portfolio.
Yep.
We want to cut it into smaller chunks into 10 different deals rather than do it in one deal. So it's unlikely we'll ever invest $1 million in one deal. Even if we grow very big, we would rather invest in 10 different deals or 100 different deals. So.
Makes sense. If you guys have more questions, feel free to put them on the chat or speak up, whoever you guys prefer. It's a very, very interesting topic actually for me as well.
Thank you. Thank you. I appreciate that.
Yeah.
So with your permission, I'll be sending you all an email with my contact information. That'll be the only email you'll get unless you respond saying, hey, I'm interested in more detail. Yeah. So,
Sounds good. Do you guys have any more questions?
Can a company be a member?
Yes. A LLC can invest in the deal. I mean, the LLC has to be owners of US right now. We eventually may open to non-US owners, but yes, the LLC can invest in the deal. IRAs can invest, not in a deal, I meant the platform is what I meant to say. And self-directed IRAs are okay. 401k, individual 401ks, self-directed 401ks are okay. So.
Good.
One question I did have for the people remaining who are kind of even semi-interested in the platform. I mean, I'm not asking for a commitment. Just, hey, this is something I may look at.
I am. I'm not sure about others. Yeah.
Okay.
Do you guys, and yeah, you can give it more time for this question. Do you guys have, because you mentioned like for the self-directed IRA and solo 401k, so for the latter, let's say, like, is it basically, I'm somewhat loosely acquainted with like self-directed IRA investments in real estate, but not super much with solo 401k. Is that a standard route or is that something you guys have?
No. That's one of those things. If you, not everybody has it. It's called a solo 401k, where if you don't have any employees except you and your spouse.
Understood. Yeah.
There are certain benefits you'll get which are even better than a self-directed IRA. So.
Okay. So you're able to partner with that. That's very useful as well.
Yeah.
For people to know.
Well, if there are no other questions, thank you so much for your time, everyone. Stefan, thank you for the opportunity. And you all know where to reach me. I believe I've given my contact information. Let me go back to that again if you like. And I wish you have a great evening and a happy new year to all of you.
Yeah, thank you, Badri. Really appreciate it. Thanks for joining today. Thanks everyone as well.
Happy New Year.
Thank you. Take care.
Yeah.
Yeah.